Let's talk about inheritance tax, what it is and why you should care about it right now. Well, simply put, inheritance tax, referred to as IHT, is a tax the government charges when you pass away, and it's taken from your estate. That's the money, property and any assets you own when you die. On a very basic level, if your estate is valued over £325,000, anything above that threshold could be taxed at a whopping 40%. Imagine you've worked your whole life to save, you've bought your dream home, and you've earmarked money to give your children a really comfortable future, but when you pass away, instead of your family receiving everything you worked so hard for, the government sneaks in and takes a huge chunk of your estate. Well, that's how inheritance tax works, and why, according to HMRC, UK families have collectively handed over, wait for it, £6.3 billion in inheritance tax between April and December last year. And here's the key point: IHT is only charged on a portion of your estate. So if you plan properly, you can potentially avoid paying a penny, but timing is everything. So, when does IHT kick in, and perhaps more importantly, how much could be owed? Well, it's complicated, but I'll try and break it down for you. The nil rate band, NRB, that's the first £325,000 of your estate, is tax-free. Sounds good, right? Well, here's where you can get clever. If you're married or in a civil partnership, you both have nil rate bands, meaning together you can pass on £650,000 without any IHT being payable. Now, if you're single or unmarried, you only get the standard £325,000 allowance. However, if you own a home and you leave it to your direct descendants, typically children or grandchildren, you can benefit from an additional £175,000 residence nil rate band, RNRB. Well, this means if you're single, you could pass on up to £500,000 tax-free. Now, for a couple, that means you could pass on up to £1 million without any IHT being payable. So far, so good, right? But if your estate is worth more than £2 million, that extra £175,000 residence nil rate band is gradually reduced by £1 for every £2 over the 2 million mark. So in this current tax year, if you're not married or in a civil partnership, once your estate reaches £2.35 million, the entire £175,000 RNRB is lost. If you're a couple, the total RNRB of £350,000 disappears completely when the joint estate reaches £2.7 million. So if you're getting close to any of those limits, now's the time to rethink your strategy. And there are two really important things to remember. Number one, any IHT needs to be paid before any money is actually inherited, which can be a massive challenge for many executors. And secondly, there is something that can change everything when it comes to being liable for IHT in the first place, and that's your pensions. Why? Well, right now pensions don't count towards your estate when IHT is being calculated, but from 2027 they will, if the government gets its way. That means your pensions could push your estate over the IHT threshold, leaving your family with a really unexpected and somewhat unpleasant tax bill. Now, here's the question to ask yourself: are your pensions going to push you over that limit in 2027? If so, you might want to act sooner rather than later. By the way, we've created a must-read guide on how the UK autumn budget has impacted pensions, retirement planning and inheritance tax. It breaks down exactly what's changing, how it could affect your estate and IHT bill, and the key steps you might need to take now to protect your wealth. Just click the link in the description below to get your copy. So, what can you do right now to reduce your IHT bill? Well, one option is gifting. What if I told you that gifting your assets or your money whilst you're still alive could lower your estate's value and reduce the IHT your family has to pay? Let me tell you how it works. £3,000 per year can be gifted tax-free. If you didn't use this last year, you can gift £6,000 in one go. You can also gift £250 per person without paying IHT. You've got wedding gifts gifts. You can give £5,000 to a child or £2,500 to a grandchild on top of that £3,000 exemption. The most important thing to remember, well, gifts to a spouse or a civil partner are always IHT free, and gifts made from regular income are also exempt as long as they don't impact your lifestyle. You must keep a really accurate record of what gifts you give. You can actually gift away as much as you like in reality, whenever you like, but here's the kicker, the 7-year rule. If you give away gifts above your annual allowances and you live for 7 years after giving those gifts, they should be IHT free. But if you pass away within those 7 years, the gift will be brought back into your estate for IHT calculation purposes, although there is taper relief that might apply, meaning the tax actually due on the gift reduces the longer you live. Now, there's also a need to be mindful that gifting money might mean losing control of what you gift, and where you gift to a family member that subsequently gets divorced, it is rather common these days. You might see half the value of that gift galloping off outside the family. But overall, imagine this. What if you could make gifts today of money you don't need to your loved ones and know that they won't have to pay IHT on those gifts? That could be a huge part of your family's future. Now, as I've said, pensions have previously been a vital part of IHT planning because they don't currently count as part of your estate, so there's no IHT due on them at all. That's really efficient wealth planning. But under current plans, as of 2027, pensions will be counted towards your estate for IHT. But if you want to keep more of your wealth in the family and out of the taxman's hands, paying into pensions can still be fantastic for your loved ones. Here's how it works. You can pay into a pension for your spouse, your kids, or even your grandkids, and they don't need to be earning a penny to benefit. If you contribute £2,880 a year into a pension for a non-earner, the government very kindly tops it up to £3,600 with tax relief, making it a really smart and tax-efficient way to pass on wealth. So here's an example from our cash flow modelling software that I think you're going to enjoy. If a grandparent paid £2,880 a year into a pension for their grandchild, and they did that from birth to age 18, so that's 18 payments, and the investment grew at 5% a year, they'd have a fund worth, wait for it, just over £766,000 at age 60, and all you'll have paid in is only £51,580 in contributions, plus the tax relief from HMRC. That's quite a legacy, don't you think? So think about that very carefully. Let's talk about trusts. These are a brilliant and very powerful way to control how your assets are distributed and reduce IHT at the same time. Now, with a trust, you can potentially ensure your family gets your wealth without the taxman taking that usual big chunk. And these are often generally referred to as family trusts because their overarching goal is to manage and protect family assets, avoiding erosion due to inheritance tax. They typically come in 3 flavours. You have bare trusts. This is where a beneficiary can access assets when they reach a certain age, and it's typically 18 in the UK. Then you've got discretionary trusts. This is where trustees decide how and when to distribute the assets held within that trust. Then you've got an interest in possession trusts. These are pretty common and often used where one half of a couple passes away and their share of the family home goes into a trust. The surviving spouse retains an interest in that half of the house for the remainder of their lifetime, typically allowing them to stay there. But when they die, it then passes to the children. But any asset can go into this type of trust, with the beneficiary receiving the interest during their lifetime and the asset passing to others on their eventual demise. Now, for larger estates, usually where passing ownership of a business is involved, there's also something called a family investment company, and these can be really, really useful, but that's for another day. The key with trusts is getting the right one. You could protect your family's wealth, you could avoid IHT, and you can keep things in the family, but you do need the right setup. But that's all well and good, but what if trusts aren't quite right for you? Maybe you're simply not ready to part with your assets. That's not uncommon. And that's where another option comes in. If you're not ready to give away your money or assets right now, or maybe you never really want to at all, you can still plan for the inheritance tax your loved ones might face when you pass away. A very common option is to take out a life assurance policy. This particular type of policy will pay out a lump sum of money when you you die. And if you're a couple, it will typically pay out on the second of you to die. That payout is tax-free, and when it's written in trust, it sits outside of your estate, meaning it won't add to the tax bill. It can also be paid before your estate is handed over. And as I said earlier, inheritance tax needs to be paid before that, so your family can use that money to help cover the inheritance tax bill, so they don't have to sell off other assets or dip into their own money to pay for it. You could say it's giving them a really important financial safety net. In summary, inheritance tax can wipe out a huge chunk of the wealth you've spent a whole lifetime building, and most people don't realize it until it's way too late. So here's the question: will you let that happen? You've worked hard for your wealth, and by not taking action, you're basically choosing to allow the taxman to take their pound of flesh. And if you don't know where to start, not a problem. Financial advice is key. We can assess your finances, we can help you protect your legacy. My advice: act now before it's too late. Okay, so now that you know how inheritance tax works and the strategies you can use to reduce it, you're already one step closer to protecting your wealth. But there's one huge mistake you might be making: taking out your pension's tax-free cash could cost you big time. You might think it's a smart move, but it can end up costing you far more in tax, amounting to thousands of pounds. So don't make the mistake of cashing in your tax-free pension money without all of the facts. It could be the worst financial decision you ever make. Now you can click here to join me in the next video to learn more, and I'll see you there.